Hey, welcome back. In the next 10 minutes, you're going to learn exactly what Treasury money market funds are, why they're crushing traditional savings accounts right now, how to actually open one and use it like a checking account, what the real risks are, because, yes, there are some, and which specific funds are worth looking at in 2026. No fluff, no filler. Let's get into it. Okay, so let's start with the basics, because this term sounds complicated and it really isn't. A Treasury money market fund is just a pool of money that gets invested in short-term United States government debt. Think of it like a savings account, except instead of your bank holding your dollars and paying you whatever rate they feel like, your money is being used to buy Treasury bills, short-term loans to the U.S. government, and you collect the interest. These funds are offered by investment companies like Fidelity, Vanguard, and Schwab. They're not FDIC insured the way a bank account is. But here's the thing. They're backed by the full faith and credit of the United States government. That's actually the same backing behind your FDIC-insured bank account when you zoom out far enough. The yield on these funds moves with the federal funds rate. When rates are high, you earn more. When rates drop, you earn less. Right now in 2026, even after some rate cuts, many of these funds are still yielding somewhere between 4 and 5% annually, while your big bank savings account might be sitting at 3% or lower and dropping every quarter. The big banks profit off that gap. You don't have to. But here's the thing most people miss. It's not just about the rate. It's about something called tax efficiency, and that's where this gets really interesting in the next section. Here's the part your bank absolutely will not mention to you. Interest you earn in a regular savings account is fully taxable at the federal and state level. So if you live in California or New York and you're in a decent income bracket, you could be giving back 30 to 40 cents of every dollar you earn in interest. Treasury money market funds work differently. Because the income comes from U.S. government obligations, it is exempt from state and local taxes. You still pay federal tax, but depending on where you live, that state exemption can be worth a full percentage point or more in after-tax yield. Let's make that real. Say you have $50,000 parked somewhere. A savings account at 4% gives you $2,000 in interest, but after state taxes at, say, 9%, you're keeping around $1,820. That same $50,000 in a Treasury money market fund at 4.5% gives you $2,250. And after federal-only taxation, assuming a 22% bracket, you keep about $1,755. Wait, that's actually less, right? Wrong. Because in that scenario, the fund pays more, and if you're in a higher bracket, the math flips strongly in the fund's favor. Run your own numbers. The point is, the tax treatment matters, and most people never factor it in. So now you know the rate advantage and the tax advantage. But you're probably wondering, can I actually use this like a bank account? That's exactly what we're covering next. This is where it gets practical. The three main places people use Treasury money market funds as a bank alternative are Fidelity, Vanguard, and Schwab. All three let you open a brokerage account for free, and all three have their own Treasury money market fund that your cash can sit in by default. At Fidelity, the fund is called SPAXX or FZFXX depending on your account type. At Schwab, it's SNSXX. At Vanguard, look at VUSXX. These are the names you'll actually see when you search. Here's how the bank replacement works in real life. You transfer your money into the brokerage account. It automatically sweeps into the money market fund. You earn interest daily, which compounds monthly. When you need to spend money, you either write a check. Yes, Fidelity and Schwab offer free checkbooks. Or you use a linked debit card. Or you simply transfer back to your regular bank in 1 to 3 business days. It is not instant. That is the main friction point. If you need to swipe a card at a grocery store today using only this account, you'll need the debit card option which Fidelity Cash Management and Schwab Bank both offer. For most people, this works as a place to keep their emergency fund or their savings earmarked for a big purchase. You keep a small buffer in your regular checking for day-to-day spending, and the bulk of your cash lives here, working harder. Sounds great, right? But before you move all your money, you need to hear the honest risk conversation. And there is one. Let's be straight here, because anyone who tells you this is totally risk-free is leaving something out. First, Treasury money market funds are not FDIC insured. They are considered extremely safe, but they are not technically guaranteed against loss the way a bank deposit is up to $250,000. In the entire history of money market funds, only a tiny handful have ever broken the buck, meaning their value dropped below $1 per share, and it was government money market funds specifically that held up best even in 2008. Second, liquidity. As mentioned, moving money out is not instant. In a genuine financial emergency, where you need cash same day, this is not ideal as your only account. Keep your emergency buffer in a real bank. Third, rates can and will fall. If the Fed cuts rates further, your yield drops. You don't lock in a rate the way you do with a CD. This is a floating rate product. Fourth, the yield is not guaranteed. It fluctuates daily. What you see advertised as the 7-day yield is just a snapshot, not a promise. None of these risks are reasons to avoid Treasury money market funds. They're reasons to use them intelligently, as part of your cash management strategy, not as a replacement for having any banking relationship at all. Now that you know the risks, let's close with the actual fund options and how to pick the right one for you. Here's your simple decision guide. If you want the highest possible yield and you're comfortable with a brokerage interface, look at VUSXX from Vanguard. It has one of the lowest expense ratios in the category and historically strong yields. The minimum is $3,000 to get started. If you want the best banking features, debit card, checks, ATM reimbursements, go with Fidelity Cash Management and let your cash default into SPAXX or FZFXX. There's no minimum, and it functions the closest to an actual bank account. If you're already a Schwab customer, SNSXX is solid and integrates seamlessly into their platform. For tax-advantaged situations, meaning you're in a high state income tax bracket, prioritize funds labeled specifically as Treasury only, not just government funds. Treasury only means 100% of income is state tax exempt. Government funds can hold other securities where the exemption is partial. Do 5 minutes of research on the current 7-day yield for each of these before you open an account. Rates change. What's best today might be second best next quarter. Alright, that's everything. You now know what Treasury money market funds are, why the tax advantage matters, how to use them like a bank account, what the real risks look like, and which funds are worth considering right now in 2026. If this helped you, hit the like button. It genuinely helps this channel reach more people who need this information. Subscribe if you want more no-nonsense money content. And drop a comment below telling me where you currently keep your emergency fund. I read every single one. See you in the next video.